Hello, everybody. My name is Natasha Phipps. I am located in Calgary, Alberta. I am a real estate investor, an investor-focused realtor, and I love doing these interviews with other industry professionals and investors to bring value to our group, to learn about one another. And I'm joined by a really special friend of mine, a guest of mine, Christian Dye. And what Christian does is very unique. It's something that I feel like we all need and look for, and I do feel like it's hard to find. So Christian incorporates real estate into our financial planning and tangible planning. So thank you so much for being here today, Christian.
Yeah, no, thank you for having me. I feel I'm in the presence of a bit of a rock star. I've always seen you in all these different forums and I follow you. But no, thank you for having me. And what I'm here to do is I'm here to educate and bring value. And that's always been my platform, as is yours.
100%. Yeah, absolutely. It's about sharing all that value and education, and we can all grow together that way. And there is always more to learn. So yeah, I'm really excited to dive into this topic. This isn't something we've kind of brought into the group, so I think this is going to be very valuable. But as a first step, can you just tell us a little bit about you and your background, and kind of how you got to thinking about this in this way?
Yeah, sure. So I'll give you the quick version. My first, I did what a lot of people did. I went to university, I studied hard, I got a degree, and I got my degree in mathematics. So I started teaching. So I became a teacher. I taught calculus, I taught economics, I taught finance. That was my first career. But my story is also very much the story of immigrant parents. And so I was born in the Philippines, but I came when I was very young. So I was 2 years old, but I came over within 2 years. My mother, my aunt, and my uncle, which were all very similar age, came together. Now, my uncle was an engineer, my aunt was an accountant, and my mother was an accountant. So similar professions, similar level of education. Now I'm going to fast forward all the way to their retirement when they all retired in their 60s. We had a middle-class income, a little bit of pension, middle-class income, a little bit of savings. And then we had 25 properties, cash flowing over 10,000 per month. Wow. Multi-millions of dollars, setting up two generations of wealth. And
That gives you goosebumps.
It gives you goosebumps.
But
what was, did they immigrate at the same time? Yes. Did they have the same parents? Yes. Did they have similar jobs? Yes. Did they come to the country at the exact same time? Yes. What was the only differentiating feature is that one of them became a real estate investor. A heavy duty real estate investor. And that was my uncle. And when I was in my 20s, I guess it's kind of like that book, Rich Dad, Poor Dad.
Yeah. I
had my own father, and then I had my uncle, and both of them were at family parties. Both of them were together. We were very close-knit family. And I guess when it really spurred my interest when at a very young age, early 20s, my mother said, you should go buy a condo. And I says, I don't know anything about buying a condo. I'm just graduating from university right now. He says, your uncle can help you. Your uncle can help you. He set up your cousin, and he set up your brother. And then I said, okay. And I'm very, very young at this time. And then I started to ask him more and more questions. He started to talk to me about it. And that first experience was interesting because that was the leaky condo. My condo, which I bought, actually tanked.
Whoa.
He got clobbered. So it was $100,000 condo, 5% down. 3 years later, it was worth $60,000. And I'm freaking out. Everyone's yelling at my uncle. It's like, how, you ripped this off. How could you have told us to do this? And all these other things. And then my uncle kind of really, really taught me a lot. And he says, Christian, you're looking at it the wrong way. You shouldn't be trying to sell. You should be trying to buy. Right. And I said, I should be trying to buy these crap condos that are just, he says, they're getting fixed. There's a 10-year warranty on them. They're pennies on the dollar, the intrinsic value. And of course, I was a math guy. I'm like calculating these things. And I'm like, this can't be right. The rent covers the mortgage. This can't be right. And then I took his advice and I actually started buying more. and the rest of the world is buying less and he's buying more. And then I just started to get interested in it. And then when I made a career shift, I went from being a teacher and then I got my MBA, and then I ended up taking over my father's practice, which was a financial advisor. So my father was an actual financial advisor. He didn't own any real estate, didn't own
Right.
much, to tell you honest. But I think he was a little bit more of your traditional financial advisor, mutual funds, insurance, things of that sort. And then when I thought, okay, here's a great opportunity for me to jump into this business. And I liked money and I liked finance. I owned a couple properties already. But then what I realized is I didn't like the model. I didn't do a lot of RRSPs, if any.
Right.
I didn't believe in putting all my money. I was a real estate guy. I
Right.
believe my uncle and I kind of ended up partnering up. And then when the US crashed in 08, he bought, I bought, we went in there dollar at par. We did all the analysis and he made a ton of money there as well.
Mhm.
And so what I started to realize is when I took over my father's financial practice, I made a shift. And I basically said, why isn't there, and I was helping clients already. I was helping them with the retirement. I was helping them with the insurance. I was helping them with their RSPs and things of that sort. But I was kind of like on the sideline saying, you really should buy insurance. You really should buy real estate. And they're like, oh, I don't know a lot about that. He says, no, I'm going to help you. And then I started attracting more clients, especially when they said, should I buy my first home? I don't know. Vancouver's too expensive. And I was like, get into that housing market as fast as you possibly can. This is one of those crazy markets. You wait 5 years. It's like, it's like watching a train and waiting for 5 minutes and then wanting to, like, it'll be so far ahead. And then all my clients ended up saying, oh, Christian, that advice you gave me on the real estate was bang on. That advice you gave me about not buying too much was bang on. That advice you gave me on getting that rental property or splitting my house to get a secondary, it was bang on. And then I thought, I think I'm onto something over here. So then I basically shifted. I shifted towards being more of a fee for service if the client wanted it. If they just said, listen, I've got my insurance, I got my investments, but man, can I use help on the real estate? Then I just started going fee for service. But if they were a client and they said, oh, I want you to quarterback everything, I want you to do my insurance, I want you to do my investments, I want you to be my guy, then now I gave them this value added service of helping them. And what ended up happening was it ended up attracting a certain type of client. Because if they want to meet with an advisor once or twice a year and then just do RSPs and TFCs, you literally have thousands of advisors that will do that, thousands.
Yeah.
But if you wanted someone who was going to meet and speak with you more than once a year or twice a year to go over, your portfolio, now we're attracting someone where me and my team have a relationship with our clients. But when I mean by a relationship, sometimes the relationship is me firing them an email and saying, here's 6 properties that I just came across this month, me and my team. One is in Manitoba, one is in Vancouver, one is in Calgary. But the cap rate's good, the IRR is good, the cash flow is good, and I think this is going to fit your criteria. And what ended up happening was that these clients are now actually getting value from their advisor. They're getting the advice that they need. I had a client yesterday, and he was almost like in a little bit of a panic because he owns rental property, he owns his own personal property, but he just had a baby. Cash flow was low for various different reasons, and he's like, I think I should sell my property. You always say, Christian, to try not to sell a property. So I said, I'm not going to say to not sell because it sounds like you're undergoing a really, really cash flow crunch. But what me and my team is, we're analyzing it. We're the guys who are going to come in to say, does it make sense to sell the property? Does it make sense to take a HELOC against one of the properties? Does it make sense to, and we're exploring, this guy's got a business, to take a business loan in order, and we'll crunch the numbers, because maybe holding on for dear life and not sell, our market's down right now here in Vancouver, our market's down by about 10%. So if this guy sells, he's taking a 10% hit on a property that literally might be worth millions of dollars in his retirement. So am I about to give this future value of $1 million away, but we still have that cash flow problem? Who's the advisor that's going to help you with that? Is your, not to throw dirt on the banks, but is the bank advisor going to solve that for you? No, they're not going to solve that for you. So I felt that there was a need. Me and my team, we created a team that helps to solve that need. We attract a certain type of investor. And I think I love that story of the average Canadian creating generational wealth. The
Yes.
average Canadian creating generational wealth. And for some people, it says, oh, I like, what is the average Canadian trying to do? They're trying to buy a home. They're trying to retire with enough money. They're trying to send their kids through school. I think that that's great. But I think what people are not realizing is that there is the opportunity in this country to go far, far beyond retiring and buying a home, and my uncle to me was this living proof of someone who was, he was almost buying, he probably bought a property every other year. And then only at 2 points in his life did he capitalize and pounce on a massive opportunity and bought 6 or 7 properties within a span of 1 year. And that was the 2008 crash. And it was also the leaky condo of the 90s, and the 2008 crash. He pounced on an opportunity, and that's what we do in our practice as well. So it's not like we're all real estate. We're all about opportunities.
Yes. Yeah.
And during COVID, when the stock market was down 27%, it was an opportunity. We were talking with certain clients who we knew had steady jobs. We knew their income was stable. We knew they could handle it, but we were actually showing them the numbers on leveraging against some of their properties to put money on a depressed 27% stock market. And they had double-digit returns within 8 months, double-digit returns. So that over there is kind of the high end of what I do, how I interact with clients.
So many awesome. First of all, when things kind of went wrong with that condo, the fact that you pushed through and were brave enough to, you probably heard a lot of, naysayers and things like that's really quite an accomplishment in yourself. And I love that that was what your uncle's response was, because he's right. Like often when people are running this way, the largest opportunity is this way. And it's scary because it feels like you're, obviously going against the grain. Yeah, so bravo, like that's such a cool story. And then second of all, I kind of wanted to touch on like how unique Christian service is. And you did mention that you went to this fee for service type of model. And the reason for that is because most financial planners, they do make their income off of certain products that they work with, right? So that's why there is a fee for service, but that advice is like invaluable, right? So that's why there is a fee. So I just want to make that clear. So people haven't worked with financial planner before. That's often why they don't include like real estate, or they don't have the knowledge, of course, as well.
Yeah. And the thing is, I guess I started moving a little bit more towards how you interact with your accountant, how you interact with your lawyer. It's very, here's a fee. Your accountant, you charge a fee, and then they provide you a service, they file your taxes, but now a good accountant should be saving you money. It shouldn't just be filing tax. They should managing and giving you strategies to save. And then if you enjoy working with them that year, then you carry on the next year. If you don't enjoy it, you switch to a different accountant. So our practice is very, very similar. If I'm meeting with you 3-4 times per year, if I'm sending you properties, 7-8 times per year, and at the end of the year, do we still want to work together, or don't we want to work? And if we don't want to work together, he says, oh, I bought 3 properties already, Christian, I'm maxed out and I've got everything all organized. Well, then that's great. I've provided you a service. But I think, one of the big questions often people ask is, how do I feel about the existing financial planning model out there? And I just sort of find that a lot of people don't want to leave their financial advisor because they have a bit of a relationship with them. Sure. And he's kind of a really nice guy. But if you break it down to what are they doing and what is the fee attached to it? Often we find that the fee, especially portfolios that are $500,000, $1 million, $2 million, the fees are in the tens of thousands, right? Yes. So yeah. You have fees in the tens of thousands, and I meet with this person twice a year. Yeah, but they did receive a 8% return after fees. They did receive a 7% return after fees. And I'm actually one of those people, and I'm a big numbers guy. I'm a really, really big numbers guy. And if you invest in real estate, just to give you a little idea over here, if you invest in real estate off of 20% down payment, if your real estate goes up by 10%, then you've gone up by 50%.
Right.
You know, it's a 1-to-5 ratio. So I'll break down the numbers. I have $100,000, and that's 20% down on a $500,000 property. So 100,000, $500,000 property. That $500,000 property goes up by 10%. That's 50,000. Okay. I put 100,000 and I've now gained 50,000. So that's a 50% rate of return. So what I've done, you know, and I'm going to show you a slide really quickly if I'm able to.
Yeah, please.
Okay.
I also love that it's like you're talking so much about diversification, whether it's different locations in real estate, different types of investments. Like that's what it's all about. Obviously, I'm like so in real estate every single day, but I tell people all the time, it's about diversification in all things. In my opinion, the people who have, you know, really taken advantage of that and getting your advice to do that is super valuable. Sorry, go ahead.
Yeah, like let's say over here, and this might look familiar to you.
Yes, yeah.
Let's say we have a condo, and let's say it's able to be Airbnb. Let's say Natasha has helped you to find a condo of this sort out in Calgary. Now, this is what me and my team are going to do. You know, we're not going to just say, you know, meet Natasha, she'll set you up. We're going to say, we're going to analyze this for you. So we're actually going to go with the numbers that are being provided by Natasha and her team. We are going to say, short-term rental rate, 165 a night. We believe that it will have a 70% occupancy rate. You know, we will run the numbers on whatever the current strata is, HOA fee, insurance. We're going to do all that analysis for you. But then what we do is we then figure out what the cap rate is, we figure out what the cash flow is, and we figure out what the internal rate of return is. And that's the piece that a lot of people don't realize. So in the last column over here, let's go to year 20. If this person holds this until year 20, we've calculated the amount that the mortgage is declining, the amount of equity that they have, the amount of cash flow that they'll receive, the amount that we're projecting that the property could be sold for. Once we calculate all of that, then the person gets their money back. We then take that amount of money and then we then say, what was the internal rate of return, annual rate of return? And the answer, 19.58. Wow. That means if I just took the same down payment and put it in the stock market, yeah, maybe I'll get 8%, maybe I'll get 9%. This condo, if the numbers are correct, the numbers are correct, that's a 19.58% rate of return. And that's why people get wealthy with real estate. That's what my uncle figured out. That's what I figured out. So, you know, if I'm at a dinner party with a group of friends and we're all talking about finance, I'm not going to talk about the property that I just got. Like I bought a property 2 years ago. I put a down payment on it of around $40,000. I just calculated the property value, the equity in it. I made about a 32% annual rate of return over 2 years. I'm not going to say that at a dinner party because number one, people probably won't believe me. How can you beat the market? You can't beat the market. What do you think you are, a genius? Who do you think you are, Warren Buffett? I said, it's not that hard. I probably need a piece of paper just to show you the math really quickly. And our philosophy is not 100% real estate, by the way. Our philosophy is a combination. It's a combination of stocks. It's a combination of real estate. It's a combination of a reserve fund, you know, and this philosophy, and here's something that a lot of people out there might not know, is that the number one pension plan in the world, actually, I'm not sure if it's number one, it's definitely in the top 5. It's got to be, is the Canadian pension plan, CPP. Canadian pension plan. It's one of the best pension plans out there. It has beat the S&P 500 by 56%. Whoa. So the average rate of return of the Canada pension plan over the last 5 years has been 12.5%. That's the average annual rate of return of our Canadian pension plan. And I'm going to show you what the Canadian pension plan is made up of. 21% is direct access to real estate. We have public and private stock making up only 46%. And then they have this massive fixed income. The fixed income is 23%. What is fixed income? 1 or 2% growth? That's like cash. That's almost nothing. Well, how can it make such a high rate of return? It's the real estate. It's the real estate that's driving them up. Now, the Canada Pension Plan, when I looked into it, well, what is this real estate? Are they investing in REITs? No, they own real estate. They
Own them.
own
Yeah.
shopping buildings. They own apartment buildings. They own this stuff. And the group, the Tiger 21, which are the richest investors in the world, the richest investors in the world, 26% of their assets are in actual real estate, which they own. So now you might say, well, Christian, these guys have teams. They have professionals, they have CFOs, they've got guys with master's degrees from Yale and Harvard who are finding, analyzing, and buying this. As an individual, I can't do that. But here's the answer. At a much different scale, you could have an advisor that's able to help you to do this.
Right.
You might not be able to do this, but you can have an advisor. You might not buy an apartment building, but you might buy a cash flowing Airbnb. You might find a duplex. You might find, a small multi-unit and add it to your portfolio, because a piece of real estate isn't TFSA RSP eligible, but so we could have that piece, but this other piece is what I feel is necessary to grow exponential wealth. I think a lot of people are just doing linear wealth and they're going to retire with a comfortable retirement, but I'm not sure someone with, making less than $100,000 a year, modest income, I don't think it's possible to create generational wealth without doing this formula, without including real estate.
Wow. That is massive. And I mean, even just having that sort of independent person, like obviously I look at real estate deals all the time and I work with clients all the time, but I'm also a realtor. Like at the end of the day, I mean, I am here in real estate. So to get that third party independent person who has nothing to gain or lose or whatever, because you're paying them a fee just to do the job sort of, right? Is like, that is a very comforting option, especially if you're uncertain, this is new to you, you don't know, how to analyze these deals, or even if you do, like people want to talk about it with somebody, right? So
and I work with it, like when I say that I work with your team, like your team might be your accountant, your team might be a lawyer. I want to be in the conversation. I just, the accountant says for tax purposes, I think they should, accelerate their RSPs. I says, okay, well, what does it look like if we did this? Remember, they can write off the interest off of the mortgage. They could write off, there are other deductions over here. And I've always been in the idea, and this is the calculus guy coming in me. Okay, here's the calculus guy. I believe in infinite returns, this concept of infinite gains, this concept of infinite, and I guess it's really simple when I've explained it to people. If I have RSPs and I have $1 million of RSPs, and that's a traditional financial advisor is going to try to bulk you up with RSPs, then I retire with my $1 million of RSPs. Well, what will happen with those RSPs? I will start depleting them. And they will start to go down. I need to start stripping, and they have to be invested more conservatively if I'm a responsible financial advisor. So is it possible to outlive your RRSP? And the answer is yes, it's possible. You might live too long. You might have, something that sort of accelerates its decline, like a mental health or something of that sort. So can you outlive your RSPs? Yes. What about inflation? Oh my God, inflation comes, my RSPs are going to get depleted even more, right? Let's take a look at that investment property, that condo, that Airbnb condo. Okay, so now I'm generating income from the condo, $100 a month, which will soon turn to 1,000, which will soon turn to 4,000, 5,000. Now I'm in retirement. I have this income stream. Can I outlive the income stream? No, I cannot outlive it. What happens with inflation? Rent goes up with inflation.
Yes.
The property values go up with inflation. Okay, but Christian, what if besides that income, I need more than just 1,000, 2,000 a month? What if I need 50 grand? What if I need 80 grand? I have the opportunity to HELOC it. I have the opportunity to borrow against it. I got other opportunities over here. If I HELOC against it, the property value still keeps going up. I sell 50 grand of my RSPs, it's done. it's gone. I never see that 50 grand again. And this is what I'm talking about, generational wealth. What happens when I pass away? Well, if you've got a good advisor and they either set up a trust or a corp or do some sort of tax planning, I pass that to next generation.
That's
I
right.
could pass that to the next generation. Maybe even I set up the next generation as that's their down payment, or that's my grandkids' down payment if my, the next generation. And so I love this idea of what my uncle has done. And he was just an immigrant who was good at math, a bit of a maverick. When everyone's running that direction, he's going that way. When everyone's when this was a guy who's buying places pennies on the dollar. He was going to court. He was trying to bid on the foreclosures. And then when I sort of used him as a mentor, I start to realize, you're not educating anyone except for me, but I can help a lot of people with this philosophy. There's a lot of really wonderful literature out there, but a lot of people, it's like reading a book. It's kind of different. It's like reading a book on personal, like going to the gym. It's like reading a book on how to get in shape. It's different than when you actually have a personal trainer. That's what I kind of consider myself. It's like when I deal with people, I'm often coaching them. I'm kind of talking them off the ledge sometimes. I have this one client, 5 properties, all at variable. The interest rates are crazy. They're like, oh my God, I think I may have made this mistake. I think I made a mistake. It says, is the cash flow there? Like don't throw the baby out the bathwater. We might need to sell one, but let's not think about selling. Can we survive off it? And I said, in 20 years, will you be looking back at the decision now, thinking and regretting it? So I to me, selling is like absolutely the last resort, but I do sell. But the only time I sell is when I'm trying to buy something else.
Right.
It's literally
trying to do something else, right? Yeah.
Here's an opportunity to buy this piece of real estate, but I need to sell that. That's like pretty much the only condition I will sell.
Right.
Later.
Yeah. And honestly, that's one of the big reasons I actually got into kind of investment focused real estate. My mid-20s, owned a couple properties, actually was dealing with some very significant health issues and being so young. And I literally went to my bank and they told me, they told me to sell, at that time. And I did sell because I there was almost a couple of years where I couldn't really work. I was quite sick. And I wish someone would have told me, number one, I could have refinanced. I had a lot of equity. No one told me that. And there was other options, but I didn't know what they were. And once I learned later, I was so peed off. I was so ticked off because, no one cared or no one told me, and I just didn't know. Right. So love that. And I also in talking about generational wealth. I mean, more and more people, no matter what income bracket they're on, are more worried about their kids and their grandkids and how they're going to afford to live in, these increasing price points and the cost of housing. And so then let's find a way. Let's find something that outlives you, that will carry on and be a story that you're now telling about your right.
Yeah. It's reminding me of my wife's parents, and they absolutely will not touch a piece of real estate like as a rental property or anything like that. They had such a bad experience. Every single time I've tried to buy a property with my wife, we have one rule: do not tell your parents. Do not tell your parents. And they just had such a bad experience. And it was, again, that immigrant story. They came from Ireland. They come here, they work like dogs their entire life. They don't take any vacations except to go back home to visit family. They never been to, certain parts of North America, Hawaii, things like that. They never went to any of it because they took every single dollar that they had and they paid down their mortgage. They paid down their mortgage. They paid the immigrant story, pay down your mortgage. They were this close to paying down their mortgage. Then they had the opportunity to upgrade their home. They took it because they were going to have a relative come and move to Canada, and they wanted to set them up in this larger home. They got caught between 2 mortgages, and the market had shifted on them, and they didn't know what to do. And they were getting stressed out like crazy. They thought the market was never going to recover. They were caught. And then they had a realtor come and say, I think you got to sell it. You got to sell it. You got to sell it. And I said, you don't have to sell it. Why don't you rent it? or why don't we do see if we could do a refinance, or why don't we do a bridge loan? Why do you have to, why I still to this day I'm like, well, why did they have to sell it? This is they were so panicked that it was never going to come back at them. They were so panicked over here. They had no advisor. They had no one. Long story short, they sold it at a massive undervalue.
Yeah.
They then had to upgrade to a home with a fresh mortgage. They says it was the greatest regret of their life. They spent decades paying down a mortgage just to start back over with a new mortgage, where if they would have held for 6 more months, the market would have recovered. They could have sold it for the amount that they should have. They could have did all this. They said this was the day pre-internet. Renting, we're immigrant. I don't know how to rent this place out. I don't know how to do this. And what I found is there was no help for them. There was no advisor. There was no one to help them out. And because of it, it's literally, remember, this house is in the North Shore. This is millions of dollars that they lost out by making one bad decision because they didn't have an advisor or the right type of advisor, and even the returns that they had over their lifetime. When I got involved, I actually looked, I think they made a 4% return on a lifetime of investments with their advisor, a 4% return.
Yeah, I've heard that often. And it's important to remember, like, when you're new to this space, I often hear like, well, why did I go through all this just to make $300 a month cash flow? It's like, it's not about the $300. Like, that's great. We want to make sure we have that every month, but it's really about, if you look at this over a lifetime, even just by doing 1 or 2 things differently, it adds up like, so it adds up such a crazy amount. And like we also said, it also can outlive you, and something that kind of carries on. So love it. Huge fan. So if I'm a new person coming to you, interested in your service, can you tell us, like, what should I expect? How much work is involved from my side? What's the process? Tell us about that.
Yeah, that's a great question. And the thing is, like, our practice is quite mature at the stage we're at right now. So we always start with what we call a discovery meeting. And a discovery meeting doesn't cost anything. A discovery really is actually, I need to get to know my client first, and they need to get to know me. And it's kind of like going on a blind date almost. We're just checking each other out. Here's the problems I have. What are the solutions that you and your team would do? If there's a fit, then let's go on a second date, but if there's not a fit, then maybe let's not. And the reason why I say that is because I wouldn't say that I am the right advisor for every single person out there. I'm the right advisor. And I think here's a quick thing that I would need to filter. I have these commitments that I give to all of my clients over here, but I have to understand that you're committed to it as well. And one of them is taking action. If I feel that you're really like, can you just imagine this, Natasha? Somebody pays me money and I'm showing them deals. I'm doing an analysis. I'm saying this would be perfect for you. This would be perfect. This would be perfect. But they take no action on any of it. And then we work together for a year or 2 years. And then what will be the end result? They're going to end up saying, you know what, that Christian, Natasha, was a terrible referral for me. He was terrible. I didn't buy one single thing. My net worth is not worth any more. We did all these meetings. We didn't do anything. I know that I'm going to show you deals across the country and the US. I know what I'm going to do, but I find that there has to be certain criteria. Like, one, if they're not even in a position to buy anything, again, I'm not sure you're going to get the full value out of me. Maybe you're still climbing out of debts. Maybe you're still, so for me, yes, I would love to meet with anyone who would love to meet with me, but let's use that first meeting to figure out, are you at the right stage for my service? If not, then I'm just going to give you as much information to help you out as I can. But if we do feel that we come to an agreement that, yes, here's a level of service, and that's another thing, my level of service comes in tiers. Like, one tier might be, I just want to meet with you once or twice a year, Christian. I come across deals all the time. I want you and your team to analyze them. I want you to help me to filter them out. I want to be able to make a decision quickly. It sounds like you and your team can help me to analyze this quick. That's just one tier. A second tier might be, I need to get organized because I've got corp here, corp there. I own this personally. I have a business over here. I've got kids. I got generational wealth I'm trying to do. I just need to get like really, really financially organized, and real estate is a huge component. That's a different tier. Another tier might be, Christian, I want you and your team showing me these fantastic deals. I want you to use your partnerships. I want you, I'm interested, and you could even bring areas and we will research them for you. You might say, you know what? I've been hearing awesome things about Quebec. I've been hearing awesome things about Arizona. I've been hearing awesome things. At our next meeting, Christian, can you and your team analyze this and tell me, how does this compare with what Natasha's doing in Calgary? How does it compare with what I'm doing in my backyard here in Hamilton, Ontario? Me and my team will then break it down. Cap rate, cash flow, IRR. Those are our three big numbers, and we will break it down for you. And so that's another tier. And then the final frontier, multi-unit. Multi-unit, commercial, land developments. It's, show me opportunities, or I'll show you opportunities. You help to analyze it. So these are all different tiers, different levels of expertise. We can help a wide range of people. We could also help groups of people. When I say groups of people, we sometimes take on families. So it's like, oh, I got me, my brother. We want to be in on it. We're actually trying to do a joint venture together. We own several pieces of real estate. And for them, it's confusing. It's like, we're thinking of selling 2 or 3 of our properties and joining and buying this apartment building. We don't know if that's a good idea.
Is that a good idea? Right.
Who's going to solve that question? The commercial realtor is going to say, do it.
Of course.
Mortgage broker is going to say, do it. The accountant, he might say do it because there might be another level of a corporation that he needs to create for you.
Right.
But really, we need an educated opinion. We need someone we can trust. And what I find is, that trust relationship sometimes builds over time, which is why sometimes people, I like them to engage with me just so that we can get to know each other. Maybe we don't do business right away, but I'm big into education. I invite them to an event. I invite them to a webinar. I invite them to get to know us. We have a women's division, which we just started, helping women to invest and to create wealth. We're starting to see a lot of divorces. And then sometimes you get women who are recently divorced, but they do have chunks of money. Maybe they got it in a settlement divorce, or maybe they just make a lot of money. We work with a lot of doctors and dentists. And what they want to do is they want to learn to be independent. They want to learn to build generational wealth. But at the same time, we've created this women's division so that you're not always talking to a guy like me. You're talking to someone who's kind of, someone who they could relate to a little bit more if they're comfortable with that. But we all work as a team.
Awesome. Wow. This is so needed. I can't endorse Christian enough, guys. Hey, if they want to reach out to you, what's the process? Do we go to the website?
The website is one way. I'm a fairly okay. So do I even have my website? Yeah. So one reason to maybe go to my website is to actually get involved. Let me see if I can do it. To get involved with some of my upcoming workshops. I'm always giving webinars and workshops, and Latitude West.ca. Yeah, so there's a workshop on there. But if somebody just wants to email me, wants to set up a discovery meeting, we're pretty busy, so don't take offense if we don't meet for a week or two. But we'll find time for you. We'll find time. It is also coming up spring break. We're hoping to take a little bit of time off with the kids. But I think I'm one of those people. I'm trying to help as many people as I possibly can, because I've been helped by so many people. They, my uncle, I think his mentorship for me, but then there's been other people besides my uncle. I've just had so many wonderful people to help to guide not only my career, but my investments. And in real estate, I've dealt with so many wonderful people that have been very educational based. And I kind of have this saying, and it goes, when you've been blessed in life, then be a blessing to someone else. And I kind of find that, I'm in a, me, my family, my business, we're doing really, really, really well. We're growing exponentially. But if I could help somebody else out there, someone who's, someone who's trying to grow their wealth, somebody who's trying to organize their finances, someone who's a little bit unsure, especially the do-it-yourselfers, the DIY guys, I find that they're going to make mistakes. I find that they are going to make mistakes. There's a level, I was just having this conversation with someone about, if I think what we were saying was if you go on any sort of financial YouTube blog or, Warren Buffett or those types of things, often you'll hear things like index funds, couch potato, dollar cost averaging. And the thing is, I don't want to throw dirt on that or throw it on the bus. Index funds, low MERs, dollar cost averaging in the stock market, S&P 500. I'm going to say that it does have its place, but you are not going to create generational wealth that way. There's no way. The numbers would, unless you're literally putting 10K a month into dollar cost averaging, you're not going to end up a millionaire. You're not going to end up where my uncle's going to end up. And I also say this, if dollar cost averaging in index funds is such a great idea, then why aren't the richest institutions, the largest institutions, the wealthiest, well, why aren't they doing it if it's such a great idea? And the answer is because at that higher level, they've got a greater capacity to do significantly more. It's not as simple. Yeah, I might tell my teenage daughter to do dollar cost averaging with index funds, but someone who's incorporated, they've got money in a corporation, somebody who's got equity in a home, somebody who's got the ability to qualify for a $500,000 mortgage. Right. I'm not telling to do dollar cost averaging with their 50K.
Yes. Yeah. Awesome points. I got to wrap it up there. Yeah. I'm off to skating for kids, but Christian, thank you so much. For those of you that are watching in Facebook, I did just put Christian's contact info in the Facebook comments, and then we will also put this up on YouTube as well. So for anyone who wants to share it or watch it again, if you didn't catch it all, we did record it. So reach out to Christian, and thank you so much for sharing everything you did today, Christian. It was a pleasure.
No problem, Natasha. And as I mentioned off camera, I'm hoping to come and visit you in the next couple of months with my daughter. And to, one of the things we're hoping to do, my daughter just turned 18 years old. And for generational wealth, you want to try to get your kids to buy real estate with your help, co-signing or, helping them with a down payment, something like that as fast as possible. Because when if the average age of a Canadian buying a home is 36.
Wow.
36. Imagine if we can get that second generation to buy homes in their early 20s. That's almost an extra 15 years of wealth that we're giving to them. And if it's their own personal property, that's capital gain tax free. If it's an investment property, that's rental income, and this is what I mean about the types of advice we should be sharing with our next generation.
Yes, 100%. I'm right with you, waiting for my kids to be 18.
Perfect.
100%. Love it. Thank you so much.
Okay.
Thanks, everybody.
Thank you so much. Okay.
Have a great rest of your day.